Hello, everyone. I'm Jonathan Tucker, Managing Director of Tucker Professional Corporation. If we haven't met, thanks so much for making time for today's presentation. I hope you'll find it to be of use. I'm trying to make things as practical as possible. And before I get into the content, if you just recently finished your residency, let me congratulate you on that milestone. That's a great accomplishment. You've worked long and hard for that. So I hope you relish your success and continued success in your work. And for those who are about to or anticipate completing residency, also continued success in your work as you approach that. Today, we're going to talk about some of the considerations that you should be giving thought to if you haven't already. And if you have, hopefully I'll give you some pointers, some practical suggestions to assist along the way with all the questions and the issues that you'll face as you embark on the next phase of your career. Just a little bit about my practice. We just deal with healthcare professionals. That's our area of expertise. And so I spend my days in this world. So hopefully we've seen a thing or two that we can pass along. And we'll have a time at the end of the material today for questions. So if you have questions, feel free. That's what that time is for. You can just use the chat feature, and Mustafa will moderate that part of the session. So let's take a look and see what we are about to cover in today's presentation. Agenda: assembling your team. Which professional advisors should I consult regarding my practice? Secondly, preparing for practice. Third, tax planning. How much should I set aside for income tax? Fourth, cash management. How much do I need for monthly living expenses? There's some questions and implications for that. Fifth, practice structure. Should I consider incorporation or stay as a sole proprietor? And then we finish off with some useful information which you may not be aware of. So that is where we're going today. Now, what I'll do, I may not necessarily stick to the order of these slides, but I will go through them to make sure that we've covered off the content here. But I want just to start with the order or the priority of things, as those who are starting into practice, they've completed their residency. You know, the first thing that you are going to want to be considering, besides how does my status change from being an employee where you were a resident getting a paycheck where tax was being withheld at source and CPP and EI was being withheld to now being a sole proprietor? What are some of the other things I need to be aware of? How much tax do I need to set aside for my self-employed earnings now that I'm no longer an employee? How much money do I need to set aside on a monthly basis in anticipation of retirement? You might think that odd, particularly if you have a lot of debt accumulated over time, or if you have some financial goals that you want to achieve in the next few years. But I always say to folks who are starting out their career, you need to look to the end and then work backwards, because if you start making decisions around your lifestyle before first identifying how much money you'll need to retire, you may very well make decisions which will make it more difficult for you to easily save over the course of your career so that you'll have sufficient funds or more than you need for retirement. So because we're all self-employed, we don't belong to a pension plan, we don't have anyone looking out for that. That is probably priority number one. And then priority number two is in terms of how much money do I need on a monthly basis, compared with how much money am I earning? Is there surplus money that can be set aside in incorporation so that I can defer tax and put that deferred tax to work in terms of earning investment income? And so those are some of the bigger questions that we'll be covering today as we go through these slides. But I wanted just to couch our conversation today around what are those big priorities. And then, of course, there's other questions like what can I deduct? Can I go back if I've missed expenses? We'll find later into the presentation today that typically we find 90%, a little bit more than 90% of all new clients coming to us, healthcare professionals, have missed expenses, and there's some obvious ones over time, and so we'll want to address that as well. So that sets the scene for what we'll talk about. Let's talk about, firstly though, assembling your team. You will need a banker if you haven't got one already. And I will, if asked, people will say to me, well, which banks do you find give good service for physicians? I would say there are three: Royal Bank, Scotiabank, Bank of Montreal. Not in any particular order, but they have identified healthcare professionals, physicians, as a target market, and they've provided services to assist. So firstly, you'll need a banker. Secondly, an accountant, somebody who has experience in the healthcare space. And then you're going to need somebody in insurance. Now, why insurance? Insurance is a synonym for risk. What are the risks you're going to face? And how do you mitigate those risks? And then finally, legal. You will need different types of lawyers through the course of your career. So where do you look and how do you qualify those professionals, those lawyers? You'll see on here that if you go onto our website, there is a list of various professionals in the Ontario area that deal in healthcare itself: bankers, lawyers, investment advisors, and so on. So if you're looking for a referral, take a look at our professional advisors page, and if you'd like an introduction, and let me know, and I'd be happy to make an introduction for you. Now, the bank, how do you negotiate, and what's important? Why do I talk about the bank? Well, it's because oftentimes healthcare professionals starting out don't know what to expect and don't know how to set themselves up for a good outcome with a bank. They're big institutions, and so sometimes I will say, or I will hear from clients saying, you know what, I don't like the person I'm dealing with, I'm going to switch banks. Before you do that, before you go to the cost and the inconvenience of doing that, and when I talk about the inconvenience, it means having downloaded your monthly statements so that you have them on file, because once you leave one bank and go to another, those PDFs that you might have access to with your bank statements will no longer be available once you switch banks. So I'm always trying to encourage people, these institutions are large institutions, so don't think that you're going to move from one to another and have a significantly different experience. You likely won't. What is key is that you have a contact, that you can pick up the phone and you can call and say, this is what I need. This is the type of account that I need. And so someone who gives good customer service, somebody who will come to you instead of you having to line up in a bank. So those are some of the important aspects that you should expect with regard to having a relationship with a bank. When you're starting out, I would suggest that you interview a couple of bankers from each of these different institutions I've suggested. And rather than appearing too eager, my tip for negotiating with a bank is simply to say, listen, I'm starting my practice. I'm currently with a bank, and I'd like to understand better what you can do for me and why I should deal with you. Listen to what they say and determine what your assessment of that individual is. Is it a good fit or not? So really key that you get a good relationship with an individual inside of these big institutions. I'll get to the corporate credit card issue a little bit later, but just a quick snippet on that, which is a corporate credit card would come if you're incorporated. I'm going to suggest that you not consider using a corporate credit card, that you consider using a personal card and use one credit card to track all your expenses, and I'll talk about that a little bit later. So there's a banker, there's an accountant that's needed, somebody who deals just in this space that knows it well. And then thirdly, dealing with risks. This is where an insurance advisor can assist you with addressing risks that you'll face. And you'll face them in 4 areas. Firstly, practice-related risks. And so that's where you will want to have some sort of coverage to replace lost income in the event that something should happen to you and you're no longer able to practice medicine and earn your income from that. Secondly, health risks, critical illness, health and dental coverage. That's the second risk area to consider. So practice-related risks in terms of loss of income. You can also think of professional liability, which is automatically covered if you're a member of CPSO. In order to be a member, you have to have CMPA membership. And so that's where your professional liability gets addressed. So that's not so much a missing piece in this area of risk. Where I find more is practice-related risks, where people don't increase their long-term disability because either they forget to or they don't think it's worthwhile. And then health risks, and also looking at not so much when you're starting out, because oftentimes when you're starting out, there isn't a lot of wealth. The assets aren't significant that estate planning concerns become a priority. But you will, as you earn income, as you pay off debt, as you invest and your wealth grows, you will also attract an income tax liability as a result of that. And so if you have family that you want to pass on your wealth to, you will want to consider having adequate life insurance. So if you have a mortgage, you'll want life insurance to cover that debt, so that in any event that something should happen to you, that debt is taken care of. So those are the areas in which risks exist and an insurance advisor can assist with. I just put those in those categories so you can have an understanding, or hopefully that will help you just sort through the various risks that you'll have. The next would be a lawyer. Now, you will already have legal issues that you're facing. You may not realize it, but you will. And here's some examples that I commonly hear. You've just moved in with your partner, so a common law relationship has been started, and yet there hasn't been any consideration to the financial aspects that arise out of that. Maybe there's a house that's purchased, maybe there are assets that are being combined, but no one ever stopped to say to you, have you put a cohabitation agreement in place? Now, that's the type of agreement that is put in place in a common law situation, whereas in the case of marriage, then there is the Family Law Act, which basically sets out the parameters and the legal responsibilities and rights of parties that are in a marriage situation. But when it comes to common law, that's where you would want to have a cohabitation agreement, which simply sets out the financial aspects as well as other aspects of the relationship. I realize it's not the most romantic topic to cover, but it is an important one. And so just like we don't like to talk about that, we also don't like to go to the dentist, but we know there are certain things that need to get done. And in a common law relationship, that's one aspect. Now, that's a legal issue. You may not have thought of it before, but that's an example of where you would want to contact somebody with a family law practice, just to say to them, okay, what are some of the things I should be thinking about? We've just moved in together. What does a cohabitation agreement look like? What does it consider? Secondly, you just bought a house. All right, who owns the house? Who's on title? Again, another example of a legal issue that you may find yourself in but didn't recognize it as such. Again, you've not had any training in this area. This is all new. And that's why it's important just to identify these types of issues so that you know to address them if you haven't thought of them before. I always say to people when we have an initial conversation or initial consultation, there is no such a thing as a dumb question. So it would be like me coming into your world, expecting me to know what you know, expecting me to know the issues that immediately come to mind for you, would be unrealistic for me to know. And so the importance in terms of your relationship with your professional advisors, including your accountant, is do I feel comfortable asking questions? You shouldn't feel uncomfortable in those situations. You should feel completely comfortable in asking questions and recognize that there is no such a thing as a dumb question. Another area where there are legal implications which you may not have considered is the offer of employment, or the offer, the agreement that has been extended from a hospital or from a clinic. Oftentimes it's just presented to a professional for signature, and you might think, well, I guess all I have to do here is sign it. Well, not so fast. You might want to have a lawyer take a look through it. Now, if that's part of a group, as in with an AFP, an alternative fee plan, or a FO or something like that, there are going to be other healthcare professionals that are in that organization, in that structure. So your ability to negotiate a unique contract will be non-existent. You won't be able to. Why? Because the other people that are in there won't tolerate it. They're not going to say, well, we'll make an exception for Dr. So-and-so over here or Dr. So-and-so over there. No, here's the master agreement, sign it if you want in. But I still say to people, have a lawyer take a look at it. Point out to you the issues that you may not be aware of that exist. And so there's another example right now that you'll be facing with respect to your employment status or the arrangement that you have with a hospital or with a clinic. All right. Then in the event of death or injury, there's the need for a will, at least for now, a single will, but in the future, possibly multiple wills. I won't get into that right now only because time doesn't permit it, but there will be a point in time where you will, as your wealth grows, and if you should stay in Ontario, in a jurisdiction where there are probate taxes levied, a multiple will is a good device to avoid or minimize some of those levies on death. And of course, a power of attorney. That's the acronym POA. If you haven't got one, you should contact a lawyer to put one in place. There will be other commercial types of transactions. If you're looking to set up your own clinic, you'll need a lawyer that will be familiar with negotiating leases, real estate purchases, and so on. So these are just some of the common transactions or events that require a lawyer, but not just a lawyer with expertise in each of those areas. Somebody who knows family law may not know commercial transactions. Somebody who knows estate planning may not know employment law or commercial law or real estate. So just bear that in mind. So that's why I say here there are different types of lawyers for different career stages: family, commercial, patent. For example, if you're doing research, then you would need a patent lawyer. So those are just some things to give you a broader understanding of the legal ramifications of you practicing. Also, did you know OMA, if you're a member, offers legal services for incorporation, review of certain legal agreements, legal templates, legal advice. It's restricted, but it is a free service that's available to OMA members. All right, so that's assembling your team. Now, preparing for practice. And under the following captions, we're going to talk about what records do I need to keep and how should I keep them? Can I write off training expenses, and do I need to register for GST? Those are just some of the highlights we're going to talk about in the next couple of slides. So if you have not incorporated up until this point, and sometimes people do it while they're finishing up their residency, but if you haven't gone to that step, then your tax status is that of a sole proprietor. That means every dollar you earn gets reported on your personal income tax return. You pay tax at ever increasing marginal tax rates up until $216,000 roughly, at which point after that you pay tax at 53.53%. And so if you don't need all the income you're earning, one of the measures of that, or the indicators of that, is that your living expenses are less than what you're earning. Then you might want to consider switching your status from that of a sole proprietor and incorporate your medical practice. All right, that's the significance of that. Of course, you'll have to apply for a billing number, and so sometimes I will say to people, if you're considering incorporation soon, you might want to incorporate now to avoid the inconvenience of having to apply once again for a separate OHIP billing number. Also, if you have staff, if you're hiring staff or things like that, you would have to apply for a CRA business number. And you may need to register for GST. What do I mean by that? It means that if you earn certain types of income, if you write legal reports as an expert, or if you appear in court and you get paid a stipend for those, if you work at a hospital and you get paid hospital on-call coverage fees, those are the types of transactions that are subject to GST. That means if you earn a certain amount of income of that type or those categories, you may have a legal obligation to register for GST. So how do you think about that? I mean, what is a broad principle, if any, of you to kind of keep track in your mind of the types of revenue that are exempt from GST versus those that attract GST? That means that you have to add GST to the hospital that's paying you for HOC fees, or add GST to other vendors that you're perhaps offering advice or acting as a witness. In those circumstances where that type of income from one or all of those sources exceeds $30,000, then you may have a GST obligation. That means you have to add GST to your bills to those entities, collect it, and then remit it to the government. So is there an easier way? Is there a general principle to think about this? Well, this is how I describe it to clients. If I'm your patient and you're maintaining or you're restoring my health, then chances are that fee for service, or the income that you're generating from that, is exempt from GST. You don't have to worry about whether to collect GST or not, because those services are exempt. But if you're earning HOC fees, if you're earning block fees, if you're issuing receipts to patients for notes or writing reports or acting as an expert witness, the government looks at that through the Excise Tax Act and says, you know what, that's like a business. You're not maintaining or restoring a patient's health when you write that report. You're rendering a service for a fee. And in that instance, those types of transactions are not exempt from GST, where the total amount of that income or those sources of income exceed $30,000 in 4 quarters. So keep that in mind. Are you maintaining or restoring a patient's health? If so, then exempt from GST. Whereas if you're earning income from these other types of sources of income not connected with maintaining or restoring the patient's health, ask yourself or get professional advice as to whether or not those types of income are subject to GST. You know, oftentimes a signing bonus can be an indicator, and those signing bonuses, depending on where you are in the province, can oftentimes, those alone exceed $30,000. And so in those cases, then you have to ask yourself, do I need to get some advice on whether or not to register for GST? So enough said about GST at this stage. This is really about issue recognition. So keep that in mind. And if you have further questions, contact me. We could discuss that further. Tracking of expenses, past and present. So this is the area about where people say, okay, here's how I'm keeping track of my expenses. I have a spreadsheet, or I'm not doing it right now. I pay for items using cash, or I pay for it on debit, or I pay for it using my credit card, or all of the above. Well, in terms of tracking expenses, firstly, my advice to people is use one credit card for everything, personal as well as practice. And oftentimes my professional colleagues will say, keep one for each. And I say, I don't advise that. Why? Because at this stage in your career, you may not recognize an expense. And so if we as accountants tell you as clients, you know what, keep a credit card separate for your expenses versus one for personal, that assumes that you actually know an expense. You know what an expense is, what a deductible item is, and you may not. And so for that reason, I advise clients use one credit card. And so we have a separate video that deals just with how to take advantage of the technology that you'll find through downloading data from a bank website that downloads and captures all of that information that you would spend hours re-entering into a spreadsheet. So the idea here is that you make all your purchases as much as possible on a single credit card. Why? you only have 12 statements a year to capture that at that point. Whereas if you have more than one credit card, there's 12 statements for each. Don't pay cash, because if you lose the receipt, then you can't claim that expense. And yes, you do need to keep receipts. You need to keep receipts for everything. I say to people, keep them for everything as a force of habit. I do. If I had my wallet here, I'd show you my receipts. And I just, every time I make a purchase, whether or not it's for my dry cleaning, or whether it's for groceries or a practice-related expense, I'm just in the habit of keeping it. Why? Because I may need to return that pair of shoes I bought, or I might need to exchange something. Just get in the habit of keeping it. And then once a month, clean out your wallet or your purse, put them in an envelope and store them away. Store them for 7 years. And as that period of time elapses, take the envelope with the receipts out after that period of time and shred them. But if you're audited, CRA will expect to see the receipt itself. So don't just assume that if you have the credit card statement, that's all you need. That's not the case. You will need to produce receipts if CRA is going to authorize you to claim those expenses in an audit situation. Now, what about past expenses? What if you file tax returns and in the course of this conversation or this session this evening, or in your reading, you discover that yes, there are expenses that I've incurred in the past that I didn't realize I could claim. And the significance of this, let me just move to a slide just to show you why I'm getting at this point. I'm not so concerned whether you've claimed things in the past as I am. I'm just looking for this slide. Give me a second while I find it. This one right here. Over here in this area here talks about how you and I are taxed, particularly in Ontario. But the reason I'm pointing this out to you is in the past, if you've been a medical resident, your income's been somewhere in this neighborhood. And so over here are your tax rates. So here's the income tax as a percentage. Here's your taxable income expressed in thousands. So in the past, you've earned your income somewhere in here, and if you follow up, you're taxed at a relatively low tax rate when you earn income personally. And so those expenses in the past that could have been deducted, you know, they're not worth that much. If your tax bracket is 20% and you have $100 of expense, you'll get $20 back on a deductible item. But look at what happens. As your income moves, as it will do, from 65,000 up to more than 220,000 in Ontario, notice what the tax rate is, 53.53%. So that $100 purchase that you would have claimed an expense down here at 20%, now the value of that deduction is $53.53. So I'm interested in looking back to find the expenses in the past that have not been claimed. Because if ever there is a time to minimize your income now for tax purposes, it's now or into the future. I'm not worried about so much what's happened in the past. I'm looking for those, shall we call them discretionary expenses, expenses where you can decide to claim them now or claim them in the future. What would be an example of that? Well, an RRSP contribution would be an example of that. You make a contribution now, but your income has been low this past year, but next year it's going to exceed $220,000. A discretionary deduction says, you know what, I'm not going to claim that expense this year. I'm going to push that forward and claim it next year. The same expense will be worth significantly more to me at that point than it will be at present. So that's an example of expenses in the past and why they're so important. You as a physician will have relatively few expenses that can be claimed, significant expenses. You might have overhead, yes, that's a big one. You might have CMPA and membership dues, yes, you'll have those every year, but in relation to your income, probably not a lot of money. The only other item that immediately comes to mind of significance may be auto, and we'll talk about that a little bit. But if you've incurred expenses in the past, in other words, if you've prepared your tax returns or you've had a family member prepare your tax returns, or you've gone to a tax preparation service that's not familiar with the expenses incurred by medical residents and healthcare professionals, I'm almost absolutely positive you will have missed some of the common expenses just based on experience and based on my knowledge. So keep that in mind. But you can go back, amend those tax returns to claim unclaimed expenses or set up balances that are discretionary that can be used once your income exceeds the tax bracket you're in at present. Okay, so now I want to talk about future cash management. How much do I need for living expenses and how much will I need for retirement? So that's the part we're at on our agenda so far. So remember I said at the outset that we wanted to consider how much you need for retirement. And if you're starting out in your career, you may think to yourself, okay, like I've got debt to worry about. I've got other things. I want to buy a house. I'm planning to get married. We want to start a family, whatever. I'm going to need cash. I don't have time to think about that right now. Before you make any significant financial decisions, buying a house, for example, which is or upgrading that house, that's where I see people lose sight of the finish line in terms of retirement, and instead spend their future savings now, and they live to regret it. So that's why I raised with you the first and most important issue I think I can talk to people about, which is how much money do you need to retire? It is not hard to figure that out. I say to people, give me 3 to 5 minutes and I'll give you a formula you will never forget in the course of your career that you can measure against and ask yourself, how much do I need to set aside? Everyone is unique. There is no rule of thumb here that says $5 million is the amount. Everyone is different. Everyone spends money differently. So keep that in mind. But it's not hard to figure out. 3 to 5 minutes and you'll have a formula that you can customize to your own circumstances. Secondly, how much money do you need for monthly living expenses? This is a question which I oftentimes see people's eyes glaze over, or they will kind of hedge as I ask, and they'll say, well, I think I need $8,000 a month, and forget that in that $8,000 a month is their CPSO fees, their CMPA membership dues, travel expenses, maybe they've got tuition that's for a master's they're working on. Those are the types of expenses which we would exclude in calculating your living expenses for purposes of determining whether or not it makes sense to incorporate. That's what we're getting at here when we ask that question. Firstly, how much do I need for retirement? Because retirement amounts saved are based on monthly living expenses. And secondly, then whether or not it makes sense to incorporate. So that's the reason why your cash management is so important. That's why there's 3 questions to ask. And of course, the third bullet there, debt obligation and repayment. It's important that you set a goal. With these lines of credit that are offered by the banks, they're happy to take your money. Sometimes I run across clients who say, you know what, as long as I pay it off in 10 years, interest rates are low, I'm fine with that. Fair enough. You're spending over 10 years a fair amount of money in interest. On the other hand, I hear people who say, you know what, I can't sleep at night, I just have to pay off that line of credit. To which I say, okay, hold on a second here. If you approach paying off that line of credit, and at the end of the day, it's your decision. When I say this, recognize this is your decision. This is your comfort level. So whether I'm your accountant or somebody else is your accountant, this is your money you're talking about, so you decide. You don't owe anybody any explanation but my job is to say to you, okay, if you choose to pay off that $260,000 line of credit as soon as possible, you are going to find that your income is going to be in a very high tax bracket. You're going to pay more in tax than if we actually managed your income over the next couple of years and came up with a strategy that over 4 to 5 years saw that debt retired. And in the course of doing that, saved a considerable amount by incorporating and taking out only what you need to live on and only that year's share of debt retirement. Sometimes people will say, you know what, based on the physician's Facebook forum, you should not consider incorporating before you've paid off all your debt. Well, to that I say, you and I will never have paid off all our debt. This is a myth. We will never have paid off all of our debt, even though we may have paid off our mortgage, we may have paid off our line of credit, we may have paid off our car loan. But while we are doing that, while we are building our wealth, we are building another debt, another obligation that we will carry with us to our graves. And I mean that literally. What is that debt? It's income tax. As your wealth increases on your death, if you've been financially successful, there will be a tax liability that will be needed to be paid. So if the logic holds that you shouldn't incorporate until all your debt is paid off, you would never incorporate. So I just say that to people in terms of keeping a perspective on this. Incorporation, oftentimes, if the circumstances are right, if the qualitative factors are in your favor, makes sense to do even while you have debt. It gives flexibility and planning opportunities that a sole proprietor will not have otherwise. All right, I think I've talked enough about future cash management, but let me give you a practical tip about how to figure out your monthly living expenses. And it does not include spending hours of creating spreadsheets over the past to try to figure out. I'm all about trying to come up with information that's reasonably accurate enough to make decisions on. So here is a back of the envelope calculation to estimate your monthly living expenses. How much do you need to live on? Well, this exercise shouldn't take you more than 45 minutes. What I'm going to have you do is sit out on this slide. So I'm going to stop talking for a moment and take a look at this slide. All right. Where do we start with in order to determine on an average how much you need to live on? Well, we start with a total on your bank statement. That's the total withdrawals from your bank statement each month. In this case, you notice I'm doing this over 5 months. Why? Because each month fluctuates, and there's going to be some items in one month that aren't in another. So I'm going to take an average. I'm trying to take a measure of what I need on average. This is not about great precision. This is about getting information that is useful for making decisions about whether or not to incorporate, how much money you need for retirement, and so on. So start out with the total withdrawals that are shown on your bank statement. All right, and go back over the last 5 or 6 months. I've used 5 months here. And now you're going to start to deduct some items. They're the items in red, because included in this individual's monthly withdrawals are practice-related expenses, CNPA, CPSO, OMA, cell phone, travel, conferences. Those items are going to, if you choose to incorporate, if it makes sense to incorporate, you won't be paying those out of your personal bank account. You'll be paying those out of a corporate bank account. And so we remove that from your total withdrawals. It doesn't belong there in determining your monthly living expenses. Then the next thing we do is we take out one-time purchases. Maybe you bought some new furniture or a car, or you made a rent deposit or a down payment on a house, or you paid for a cruise now that we can travel. Those are one-time items. We want to pull those out entirely as well. So first, we take out practice-related expenses, this row here. Second, one-time deposits. In this case, the person that paid $2,800 for exam fees. One time, take it out. Doesn't belong as a living expense. And then finally, debt repayment. That line of credit that you're paying off. Well, why would we take those? Why would we take that number out? I mean, that is, I need to pay that debt off. The reason, we're going to set up a separate loan repayment plan to address that. But let's take that right off the table and figure out, after we removed practice-related expenses, one-time purchases, debt repayment, how much do you need to live on after those items are removed? In this case, you can see monthly what it is and what the average is. This individual needs about $6,300 a month to live on. If that's the case, then they will need approximately $75,000 a year after tax, which is probably pre-tax about a little over $100,000. Now, this is information that an accountant needs in order to determine whether or not it makes sense from this perspective for this individual to incorporate. Because if this individual here is making $220,000 and they only need $107,000 of that in pre-tax income to cover their living expenses, then that's one indication that they ought to be considering incorporating. Now, as I say, this should not take more than 45 minutes to go over the last 5 or 6 months to do, but this is invaluable information. So you can do this on the back of an envelope, on a piece of paper, on an Excel spreadsheet, I don't care, but that's how you're going to get to that number. it's also useful in terms of calculating how much you'll need for retirement and how much to set aside as well. All right. If you're interested in more on this, then check out our website under the video shown on the screen, and this will give you the steps to and the spreadsheets needed in order to obtain that information. All right, now practice structure. Should I incorporate or consider incorporating or not? And so I've spent a little bit of time talking about the factors to consider, and one of those is how much you're making, how much you need to cover living expenses, but a little bit about some of the considerations and what you are presently if you haven't incorporated and how that impacts your tax situation versus if you decide to incorporate, what are the implications for that? So as a sole proprietor, you finish your residency in which you are an employee, and then in that case, then your default position from a tax perspective is that of a sole proprietor. What does that word mean? It means every dollar you earn gets reported on your personal tax return. If you make $50,000 of self-employed income, you report $50,000 of self-employed income. If you make $500,000 of self-employed income, you report $500,000. But if you decide to incorporate because you only need $107,500, as was in the previous slide, but you're making $500,000, then the only amount that's going to appear on your tax return for that year with proper tax planning is $107,500, and you will pay tax based on that level. The rest of the income will sit inside of a corporation taxed in that corporation, depending on the province you're in, but in Ontario, it'll be taxed federally and provincially at 12.2%. So therein lies the difference between incorporating versus as a sole proprietor. What are the considerations then? Well, your default position, you're a sole proprietor. Cash flow implications, you're going to pay the tax that on the income you've earned this year. If you earn $300,000, you're going to have a large tax bill next April to pay. And then you will also have installments based on that level of income to pay as well. All right, so what's that mean? It means if you're trying to pay off a line of credit and you don't need all the income you're earning, and your income is in excess of $220,000, then right now your cash flow is going to be absorbed in income tax payments and income tax installments, such that you will be restricted in paying down that line of credit, restricted from setting money aside for that down payment. Why? Because there's no tax planning that's going on, because there's no tax planning available. What you earn is what you report on your tax return, and that's the tax that gets paid based on that level of income. Now, the advantage is that you don't have to go through the cost of incorporating. The advantage is the cost of preparing your personal tax return are cheaper than having to go to the professional fees of incorporating and maintaining a corporation. So that's a consideration. But another factor is that you'll have to report your income on a calendar year basis. That means from January to December, what you earn is what's reported on your tax return. If you incorporate, you choose the year end that you want your corporation to have for the calculation of corporate income tax. Again, it gives you flexibility. So you can defer tax by having a non-calendar year end date for a corporation. You can't do that as a sole proprietor. And then, of course, I've mentioned that with a sole proprietorship, you will have cash flow obligations arising with respect to income tax installments that may be able to be deferred in the case of an incorporation. Now, if you incorporate, what are some of the implications? Well, again, you can report only the income that's withdrawn out of your corporation and control the level of income tax that's paid. Now, I don't want it to sound as though this is all about how much money you're earning versus how much money you need to live on, because there are other considerations that need to be factored in here, such as where will you be practicing? If you're thinking to yourself right now, as many of our clients are, well, I'm going to be in Ontario, but I'm looking at doing some locums out of province, maybe up in the Yukon or in Alberta or out west. Well, the income that you're earning that would normally flow through a professional corporation is only the income from the province in which that corporation is registered. So if it's Ontario, then only the income earned inside of Ontario will flow through because that corporation has received its certificate of authorization from CPSO. So if you're earning out of province, that income you earn out of province will be earned as a sole proprietor versus income earned through a corporation in the province of Ontario. So if you're thinking of relocating, if you're not certain, if there's some question as to whether or not you're going to be here or you're going to be in Alberta or in BC or south of the border, then you may want to give some thought as to whether or not it makes sense to incorporate at this point. Now, it still may do. So what happens? What happens if you incorporate now and in a couple of years? I dealt with this with a client a few days ago that decided they were going to move down east to do a fellowship, and they had already incorporated. What do? Do they set up another corporation out east? Well, it could. That's just increase their professional fees to do that. But you can file articles of continuance that would move that corporation that's presently incorporated in Ontario and move it out to Newfoundland or move it west to BC. So you file articles of continuance. If you want to jot that down, that's the term. That's the legal procedure to move the jurisdiction of the corporation. And then, of course, the income you earn in that jurisdiction can then flow through the professional corporation. Are you a U.S. citizen or not? That also factors in. Doesn't mean you can't incorporate, but there are considerations such as you will not likely have a non-December year end. Just for practical purposes, you'll want to have a December year end because the income you earn through that professional corporation for U.S. income tax purposes is earned as a sole proprietor. So for ease of collecting information to report on your U.S. tax return, your corporation will want to have a December year end. Do you own shares in another corporation? What do I mean by that? Well, perhaps a parent was a professional. Maybe they were a lawyer, maybe they were a doctor or a dentist or an accountant. And during the course of your medical education, when you were at university, this goes back a few years, perhaps shares were issued to you so that you could receive dividends at that point in time that would pay for your medical school. If that's the case, you will want to surrender or have those shares redeemed before you incorporate. Another consideration. And then the types of income that you will be earning and what's permitted by CPSO. So if you're an enterprising physician that would like to earn income not only from the practice of medicine, but you fancy yourself earning income from, other business ventures, then you may want to consider whether or not that type of income flows through your medical professional corporation. In fact, you may not be permitted to do that. And then, of course, the other consideration is the cost of incorporation. You have options there. You can have a lawyer assist with that, and they will charge you based on firm rates. For those who are members of OMA, OMA Legal Services offers a service that will incorporate, I think, for about $550, including the resolutions and so on, and then another $400 is paid to the college for them to issue the certificate of authorization, which is needed. All right. So if you want some more information on that, I recommend you take a look at, again, the video on incorporation that we did a few months ago. That would walk you through some of the issues in more depth than I've covered here. All right, other useful information. And I see my time is quickly running out. So let's just quickly look at some resources you may not be aware of. If you get audited by CRA, how do you respond? Now, the reason I raise this is because, as you probably are aware, there are a lot of scams around, people purporting to be from CRA, trying to get your information. How do you respond? Whether it's a phone call or whether it's not as likely that it's going to be in the form of correspondence, that a scam is going to exist, although I have seen that it's more likely going to be a phone call. And so how do you respond? Because there is the risk that it actually could be CRA trying to gather information, and they do use the phone. So how are you going to determine whether or not the person on the other end of the line is actually a CRA agent or is a scam artist? Well, I always say to people, don't answer questions from anyone at this point. You don't want to tick off a CRA auditor by appearing to be uncooperative. So just explain to them, listen, there are a lot of scams around right now. You may be legit, you may not be. I'm not going to answer any questions. But what I will do is I will call the 1-800 number for CRA, and I'll talk to them on my terms and ask if there's anyone from the agency that's inquiring about information. So don't give that information just to anyone who calls. I will tell you that one of the tests or proofs that it's actually CRA on the other end of the line is they will never ask you for your social insurance number. They will never ask you for a credit card number. They will never ask you for immediate payments over the phone. Those are some of the telltale signs that that's a scam that's trying to take advantage of you. So be aware of that. If you call CRA as a result, and they say to you, yeah, we are trying to reach you, we've got some questions, I would politely say to them the following. You know what, I'm a physician. I don't know anything about this stuff, which is why I have an accountant. Can I get your name and phone number, and I'll have my accountant give you a call and address your questions and provide you with the information you're looking for? Because they will ask seemingly innocuous questions, but they're not at all. And so if you answer not realizing why the questions are being asked, you may actually make things worse for yourself. All right, that's dealing with CRA. And then when they send out requests for information letter, we call them RFIs, but they will send out, you file your tax return, they send a letter back, make sure that you respond on a timely basis or have that information uploaded to your client portal so that your accountant can take a look at it. We get hundreds of these a year. They're just a matter of course, easily responded to, but they are time sensitive. And if you don't respond in time, they'll deny the deduction that they're inquiring about, and they'll increase your taxable income and increase your income tax. So time sensitive, deal with it. And your best advice is to get that taken care of by an accountant. All right. Now, best practices for exchanging confidential information. I put this in as obvious as it may seem. Don't email your tax return to your accountant. Even if it's password protected, you should use a client portal that's secure. And the same thing with CRA. CRA will allow you to set up a client portal. They'll send you email notifications indicating that there's information in your portal. I can't tell you how many of our clients don't even look in their CRA portal to see notices or notices of assessment or installment requests or things like that. You've got to get in the habit of checking your portal. But don't email your confidential information. It is not secure. Make sure you deal with a firm that uses a client portal that uploads information. You'll get a notification when the firm uploads information to your portal. And in the same way, when you upload information or scan documents and upload those, we get notifications saying, hey, Dr. So-and-so has just uploaded their notice of assessment or a letter. So that's just a suggestion in terms of exchanging confidential information. Don't email spreadsheets. You can always upload a spreadsheet or use Google Docs and share access that way. Those are just some best practice keeping your information secure. And then if you're looking for additional information, for physicians, there is the New in Practice CMA publication, which is available to CMA members online. Great resource. I don't know if it's still the same individual who was involved a couple of years ago as one of the editors, who is both a physician and a CA, has done an amazing job of identifying the issues, some of which we've covered here today. So that is a great resource to take a look at, New in Practice. There are government forms that you may have heard of. Take a look on our website. We have a library of government forms, and there's also the Government of Canada website as well. For professional advisors, take a look at our professional advisors page. Have no hesitation with the individuals listed there, and they will have experience in the healthcare field. For physicians who are looking for available positions, Health Force Ontario, if you're not familiar with that, take a look at that. They are excellent as a resource in terms of placing physicians and opportunities. And then for family doctors, Billing and Practice Guide for Family Doctors, which is an OMA publication. Again, another very good resource. We haven't talked about auto expenses, and if I had more time, I would take you through that. But one of the requirements, so quickly, the expenses if you're using your vehicle for earning your income. If that's the case, then the following expenses with respect to your vehicle can be claimed: fuel, repairs and maintenance, insurance, interest on a car loan, lease payments. Their lease payments are subject to some restrictions. A portion of the purchase price of the vehicle, again, subject to restrictions. There is some accelerated amortization or accelerated capital cost allowance for hybrid and ZEVs, zero emission vehicles. So again, those are the types of expenses that can be claimed. I didn't mention parking or 407 ETR. Those are auto expenses, but you can't claim all of them. You can only claim a prorated share of the expense based on the kilometers driven for your practice in comparison to kilometers driven in total. So you'll need to have some means of keeping track of your kilometers. Trust me, don't use a notebook in your car. I would be terrible at it, and I'm a pretty detailed person. There are apps out there. The one I recommend, which you can have on your phone, is called Mile IQ. And it keeps track of keeps track of your driving. So Mile IQ, take a look at it. There's some YouTube videos on how to use it and what it does. We also have our expense tracking worksheet, which is a huge time saver. So we're happy to make that available. And there's a video on how to use that in a fashion that shouldn't take you more than 20 to 30 minutes a month at most to keep track of your expenses, so that at the end of the year, you won't have to go through and spend a day or two or three pouring through your receipts and coming up with a spreadsheet that doesn't capture everything. Do it as you go. So if you want that, take a look at our video on expense tracking, and we'll be happy to provide you with that, with the expense tracking worksheet. All right, how did I do? We have 3 minutes for questions. Unless there's more questions, I'm happy to stick around, but we did promise an hour. So any questions, Mustafa?
Nothing yet.
Nothing yet. If nothing comes to mind at present, but after tonight's session, something you do have a question or two, feel free to contact me, and I'll be happy to answer your question either by phone or at that email address. Or if you'd like to book a complimentary appointment just to work through the specifics of your own situation, this is how you can get in touch with me. I'd be happy to give you an hour of my time just to talk about your circumstances and give you some guidance, no obligation, but you may find that helpful. Any questions, Mustafa?
No. No
Nothing?
questions. No.
All right. All right, everyone, thank you for your time. I hope this has been helpful. I appreciate your interest. And as I say, if you have any additional questions, please feel free to send an email or give me a call, and we will be happy to assist. Upcoming webinars include 5 ways of taking money out of your corporation. That'll be in September. And then in October, Canadian income taxation of investment income. So in the meantime, feel free to look at our website under resources and videos for past videos. You're welcome to access them anytime you like. Well, thanks everyone for your time. Wish you well and continued success.
Sorry, Jonathan, we just have a quick question here.
Okay.
Just give me 1 second. So I'm a 5th-year resident and will be coming outside of my normal residency schedule during the year. For 2021, I estimate 10 to 12,000 from locuming at other practices. How much
Yeah.
of the locum money should I put away for taxes?
Great question. I would say, to be on the safe side, 35 to 40%, just to be on the safe side. Normally what I say to people is, if you'd like more precision, then get a tax estimate. In other words, have an accountant. We do this all the time throughout the week, where we gather. So what you'll have is you'll have a T4 slip this year, or you'll have a pay stub, which will show all of the income that you've earned up to date. And then what you expect your estimated income to be thereafter. And we do a tax calculation. We tell you, okay, you've had this amount withheld from your paycheck. You're going to earn this additional amount of income. The amount of tax on that is this amount. So you can use a rule of thumb, 35, 40% if you like. That will probably be generous. Or if you want more precision, then have a tax estimate done. Any other questions?
That's all for questions.
That's it? All right. Thank you, everyone, for joining us today. And I look forward to seeing you inside of our future videos. Take care now.